All right. Welcome to Degrees of Freedom, where I go over 5 slides in 15 minutes about the note industry so you can understand and be enlightened a little bit more about your own degrees of freedom. My name is Dr. E or Dr. Engerman, Dr. E for short. And if this is a topic you'd like to know more about, please hit that like bell or notification, the notification bell, and the subscription. And you can learn more about this degrees of freedom in this exciting industry called the note industry. Today, I've got a really exciting one for you. This is all about noting by the numbers. I'm going to try to break down some really difficult economics topics that you really don't learn about in school at all. And we're going to cover these 5 issues. The first is investing principles. They are investor principles that I've learned on my own from some years of investing. Then we're going to talk about banks and credit unions. Then we're going to talk about default loans, the U.S. debt situation, and what it really means to be a creditor. So I can't wait to get started. Tune in. Okay, guys, here we go. We're going to get this thing started just like this. There we go. All right, look, the information presented on the Engerman Estates channel is for educational uses and purposes only. It is not, I am not a licensed financial institution. I am not an advisor. I'm not a financial strategist. I'm not a lawyer or a CPA. If you need that assistance, please go seek so elsewhere. Engerman Estates is not liable for any losses resulting from any actions taken by a viewer based on the information presented or shared on this channel. Engerman Estates cannot promise earnings or returns based on historical reports or achieved by any party or affiliate in connection with this information. I'm going to get moving because this topic is too juicy to let loose here, to let slide. Check it out. I have been investing for approximately, I think formally 4 or 5 years or so. And there are some things that I've learned in this industry that have really helped me become a better investor. And there are these basic principles. So I'm going to break them down for you. The first is rule in investing is not to lose money. Simple, plain. That's it. Don't lose money, y'all. That is the first rule, and it's the second rule, and it's probably the third rule for many people that actually have money. So don't lose money is the first rule. The second rule or principle is asymmetric bets. What investors are really looking for is putting in a little bit of money and getting out a whole lot, right? They're really looking to multiply their investments, whether it's 2x, 3x, 4x, or the ever elusive 10x. They are always looking to see how they can create an investment, whether they generate it themselves or they get it through deal flow, and it multiplies on itself. There's lots of little tricks that you can use to do so. One of the most obvious, I think, is investing in a business possibly, or stocks that are pre-IPO, and then once it hits IPO, it really starts to multiply on itself right away, immediately. So asymmetric bets are things that investors are really, really looking for. They always say these next 2 terms, the first is never try to catch a falling knife. And what that means is when the market turns for the worse, whether it's stocks or whether it's an investment of some kind, people are trying to time the bottom. And that's when this term kind of emerged, which is don't try to catch a falling knife, right? You're going to get cut by the falling knife. So you don't know when the bottom is. All you know is that the market is down. And real investors understand when there's blood in the streets, they are going in. Why? Because they've done their research, because they've done their homework. Okay, so they're not just going in blind. They're not just buying stuff up because they're just bottoming out. They understand where that asset is, what its real value is, and the timing and the circumstances under which they should be putting their chips in. So we don't want to fall or try to catch a falling knife. The next one is a dead cat bounce, which is a really interesting concept that I found out about, which is as soon as something is falling, whether it, usually we think of in terms of stocks, when it is falling, it's always going to have a rebound of some kind. It's always got to come up a little bit. That doesn't mean it's not going to lay flat. Okay, so you also want to be very careful with that. So when markets are down, again, those two terms basically say you can't time the market. You don't know when the bottom is. You have no idea. No one does. No one has this crystal ball. You have, insight. You have insight and you have an inkling, but that's about the best you can get. So even a dead cat will bounce, essentially, is how that works. The rule of 72 is pretty straightforward. It says that if you take your annualized compounded interest on an investment and you use it as the denominator, right, and take 72 and divide it by that number, that's how long it's going to take for you to double your money. Okay, so we know 6 and 12 gives us 72. So if I've got a 6% interest that I'm going to earn as a return on my investment of annualized, and I take 72 and divide it by 6, it'll tell me that 12 years it will take 12 years for me to double my money. Okay. Time value of money. Wow, that is a good one. Time value of money basically says that the longer time continues, the less and less the value of the dollar it becomes. So the longer you hold the dollar without doing anything to it, without putting into work, without putting it into motion, the less and less value it has. So this all brings us down to this common denominator, which is the velocity of money. What bankers really understand better than probably many other people and investors on the planet is the velocity of money, the ability to turn the dollar quickly, to invest it immediately, to make sure that it's being put to work on asymmetric bets, and understanding that when the markets are down, that's when it's time to move in on something that they really, really understand, and understanding when that dollar amount will double on itself, will multiply on itself as a function of continuing to spend the money quickly, right? Quick in, quick out, quick in, quick out. All right. It's about being able to earn 5% today versus waiting for the 20%, down the line. Earn it now, earn it quickly, and move the money as fast as you can. All right. So these ideas and concepts really allow us to understand what's going on in the markets. If I'm moving really fast, that's okay. You've got the ability to rewind this thing. I'm going to get moving. First Research did this study, or actually reported on this study, but the global banking revenue is expected to fall by 14% from their pre-existing trajectory by 2024, according to this McKinsey study. Basically, what's happening is banks are losing certain revenues, right? And approximately it'll lose up to about $4 trillion. And what we see is there's about 5,000 commercial banks and about 5,300 credit unions. And so their revenue annualized is roughly in the $530 billion range. Now, that doesn't mean that's how much assets they have, right? So we understand the difference between holding assets that have incredible value versus money flowing through revenue on a regular basis. There's two different concepts. So they have about $13.5 trillion in assets. But what we can see here as a trajectory down on the bottom left, I'll use my little cursor here, the commercial banking and savings institutions are contracting. Okay, that's what this means. They are becoming less and less of them, which means the bigger guys are eating up the little guys. It's classic capitalism. This is just what happens. Over time, the little guys are going to get eaten and consumed by the bigger guys. The bigger guys become bigger and bigger and bigger. And it's not just the commercial banking institution, it's also the credit unions as well. So the same things are happening. So what we see is certain banks, banking in general, we're losing some funds, okay? We're going further into debt, and we're seeing that more banks are carrying bigger loads of debt. That's what this says, okay? That's what this says. If you look here, a simple explanation of this shows you clearly that interest rates are going down. These are 200 years lows for interest rates. We know banks make money on what, right? See how this makes sense? You see, we're losing money. Interest rates are falling down. Banks make money on origination. That's what they're interested in doing. All right, a little wink, wink, inside information. So what we see here, this story that is forming here, and you go check it out, do the research on your own, is that banks are growing further and further into debt. Okay, and bigger banks are carrying more and more of the debt. And so what we see is there's more availability for what? For secondary and tertiary markets to purchase some of this debt. So banks are going to need the secondary and tertiary markets more and more and more. All right. I got to move to default loans. So what happens when a loan goes into default? Well, the same thing happens with an individual that would happen with essentially a bank, although they have different tools that they could use. And if you're a deeper economics understanding, you can go into that all you want. But I'm just giving you some of the basic plain facts. And this is what happens. Look, you get late fees, you get penalties, you get lower credit scores, you get the garnish the wages, they freeze the bank accounts, rents and finding jobs become more problematic, right? It becomes harder for people to loan you money, be harder for people to rent opportunities and get other types of loans, right? Finding jobs obviously become a problem, and it halts, this is the big one, it halts cash flow. Remember, we talked about the velocity of money before. The velocity of money is really important because what does that do? What that does is that continues the engine. It continues to turn the money. It continues to move the dollars in a sense, and the economy engine keeps moving. So when people don't pay their loans, everyone's in trouble. Okay, it's a big problem, not just for banks. It's a big problem for us individually, for businesses, the entire government, and the entire economy. Big problem, okay? So defaulting loans is not fun for anyone. It's not fun for anyone. So let's talk about who owns a ton of debt, okay? Who has a ton of debt? And it's us, okay? It's us. I'm going to show you this. I'm going to break this down for you. I'm going to show you with visuals first, and then I'm going to actually show you the physical balance sheet. This is out of the Treasury Department. Dr. E didn't just generate this himself. This is out of the Treasury Department. Okay, I didn't create this thing. So check it out. The government's assets and liabilities as of September 30th, 2021. This was released. This is one of the most update versions of the current financial balance sheet of the United States. And so we can see here, this is in billions, so that would represent a trillion, okay? 1,000 billion equals a trillion. That's how you read this. And so over here, we got total liabilities, $34 trillion, okay? And this is how it's broken up. Federal debt and interest payable, right? Federal employees are sitting here and other are here. And so when we add these two, we get the balance, which is clear, right? You do the basic math. That's 34. That's about 4,000 to 5,000. So we're sitting almost at about 30 trillion right now. And there's probably more than that in debt, right? And liabilities. Check this out here, the U.S. budget deficit and net operating costs, again, in a different visual showing us the same information. Now, over here is that line by line balance sheet. It's much longer than this, but here are the basic parts. If it's in parentheses, that means it's negative. I'll say that again. If it's in parentheses, that means it's negative. Okay, that's debted. That's owed. All right, our gross costs, owed. We're in the red. All right, total net costs, owed. Okay, total tax and other earned revenues. As you can see right here, all right, Republican, Democrat, I don't care who you are, what side of the fence you're on. Okay, check this out. Taxes, bring in money. That's where we're in the plus. So that's why we keep talking about having this conversation of raising taxes, don't raise taxes, who to raise taxes on. That's the conversation on the balance sheet, because that's the only positive we've got. Everything else is straight debt, all right? Net operating costs, debt, budget deficit, debt, okay? All of this down here to fellow employees and everything we just talked about. Debt, owed, debt, net position, debt, lots of it. See the picture? Okay, so here is the big cheese. Every single week, I give you a golden nugget, and here it is. And it happens quick, so you better not blink. What is being a creditor? It's owning the debt, y'all. I had to give it to you quick. I couldn't hold it. Couldn't hold it in. All right? The suspense was killing me. Look, it's owning the debt. Bada bing, bada boom. You think we're on the right side? Oh, yeah. On the right side, y'all. Look at this. As a creditor, you are a lender. Okay? You lend to borrowers. Okay? And there's a legal instrument. It's the law. Legal instrument. As debt keeps building, okay, you start to own some of it. You start to learn about it. And that's what note investing is about. It's about learning how to be a creditor and be a good creditor. Okay, this means that we're interested in, Remember those last points I made. We're interested in maintaining the velocity of money, maintaining the flow of cash. We're not interested in kicking people out of houses and homes. No. We want them in the homes. So it continues the flow of cash. It continues the move the dollars and cents around. Now we're just on the right side of it. Look, it's a secured asset. They're secured, meaning that you're in first position. If you do it right, you're in first position, and it is a hard asset. It's secured. Okay, these are the guys that get paid out first, the creditors. All right, with secured assets. Okay, you're in a controllership position. That's what being a creditor is. You have legally enforceable paper. It's the law, right? You are owed. What you got to do is put yourself in a great position so that your upside is plentiful, because what? You understand those investment principles that I mentioned earlier. Buy low, sell high, right? Looking for asymmetric opportunities, putting yourself in position to build credit, right? All right, there we go. Rights and privileges are yours. So look, that's all I've got for today. It's quick, fast, and dirty. I told you the nuggets are quick and fast. Listen, if this is more that you want to learn about, please subscribe, hit the like button, hit that notification button, hit me up via email. It's all good, and I'm hoping you're having a fantastic day. One family.